is the market rigging the ultimate bear trap right now? The market's been bleeding red, support's been shattered. 45,000 jobs, gone in a week. But don't toss in the towel just yet. The Fed's cooking up a 2026 cocktail that could really get you going, okay? Quantitative easing, it's a twist that's coming that could absolutely flip the crash into a jaw-dropping rally. So stick with me. The hopium might be the script flipper that you've been waiting for. Now, we need to define some terms, okay? A lot of people hear rate cuts and automatically think that means quantitative easing, which is the Fed buying back bonds from the market. It's not, okay? Rate cuts feel like easing because they make borrowing cheaper, but they don't actually pump new money into the system, to be clear. Now, when they bring rates down, the housing market will unfreeze, and that'll bring a lot of chillness back to the economy, we could say. Rate cuts work on the short end of the curve. The Fed lowers the cost of borrowing and hopes that consumers and businesses will take out more loans, spend more money, stimulate the economy. It's indirect. The Fed is basically saying, here's cheap credit, go use it. Most of the time, that's enough to get things moving. QE is a different beast entirely, and the end of quantitative tightening, which is ending on December 1st, is not the same thing as quantitative easing. With QE, the Fed literally creates new money electronically and uses it to buy assets like treasuries and mortgage-backed securities. Those purchases inject massive liquidity straight into the financial system, pushing down long-term yields and lifting the price of almost everything. Stocks, bonds, crypto, you name it. It's not encouragement, it's force-feeding liquidity into the market. But let's rock through it one more time. In simple terms, the United States Treasury issues bonds. The market buys those bonds, including the Fed. Here's where magic happens. During quantitative tightening, when those bonds mature, the Fed doesn't reinvest the money it gets back. It just lets it run off. It lets the cash disappear out of the system. During quantitative easing, by contrast, the opposite happens. When the Fed gets money back from maturing bonds, it uses that cash to buy more bonds. That extra demand pushes bond prices up. So a $1,000 bond might start trading for $1,100, but the interest payment is fixed. So as an example, if it's 5% interest, it's a $50 per year yield. That means the yield then drops because the price of the bond has gone up from 5% to around 4.5%. Now, savvy investors hate lower yields, so they rotate out of bonds and they move into higher return assets like stocks and crypto. That rotation, plus all the fresh liquidity, is what pumps markets. The difference becomes pretty obvious when you look at history. In 2008, the Fed cut rates all the way to zero. Now, that was a response to a massive crisis, but markets kept crashing. It wasn't actually until QE1 began that liquidity returned and equities finally found a bottom. Same thing in 2020. Rate cuts happened first, but it was unlimited QE that actually revived markets and set off one of the strongest bull runs ever. You can have rate cuts happen without a massive collapse. It's often rate cuts come in response to massive dysfunction in the economy. But we have had a great example in the past of when rate cuts happen and they don't blow everything up, at least not immediately. That was the dot-com boom when they started cutting rates in the mid-90s. Things went up massively from there, okay? Now, before we get into the sneaky ways in which the Fed's going to start pumping money back into the economy, crypto traders, listen up. NORDVPN'S Black Friday deal is live right now. It's the biggest discount that they've offered all year. If you've been putting off getting real crypto security, this is not the moment, okay? Crypto is not anonymous. Your IP is exposed. Scammers run fake exchanges. Malicious wallet addresses are everywhere. One mistake can wipe you out, okay? Having just a hardware wallet is not enough. NordVPN protects you by encrypting your connection, hiding your IP, blocking dangerous sites with threat protection, and now their crypto wallet address checker instantly alerts you if you've found an address that looks malicious. Plus, using a VPN will allow you to access some services that may not always be available in your local jurisdiction. That feature alone, though, the address checker, can save your entire portfolio. Think about it. One mistake, people lose it all. For a few bucks a month, you could not make that mistake. Black Friday deal is on right now. It's the lowest you're going to get the price for NordVPN all year. It won't be cheaper later. Don't wait. Protect your crypto. Protect your privacy. Grab the best damn prices before it's gone. There's a link right down here. Don't delay. Go hit it now. Pause the video. Come back in a few minutes. Finish this up. Go check it out. Link down below. Thank you for NordVPN for sponsoring today's video. So the Fed has already announced it's going to stop QT by December 1st. That does not mean QE automatically kicks in. It just means they're done pulling liquidity out of the system, which is good. puts a lot less stress on the system. But here's where things get interesting. Some analysts argue that ending QT this early looks and smells like the first step toward quantitative easing coming very soon. Now, in their view, you don't need an official QE announcement for the market to feel the effects. That's why people are calling it stealth QE. A lot of people are saying they're going to call it just technical adjustments. Liquidity is creeping back into the system. The Fed's not going to admit anything publicly. It doesn't want to make the markets too excited, but it's there if you look in the background. And when you look at the actual data, the timing makes sense. QT has been running since June 2022, and in that period, bank reserves have been drained aggressively. Okay, it's been a sledgehammer. U.S. bank reserves recently fell to around $2.8 trillion, a four-year low after sitting near $3.3 trillion earlier this year. Analysts warn this level is getting dangerously close to the point where liquidity is no longer considered ample. If reserves fall too far, funding markets can seize up. We've already seen some stress in those markets. The Fed absolutely wants to avoid. So in fact, they had an emergency meeting with banks over the weekend on this exact topic. Not all is well below the surface. The markets demand more liquidity from the Fed. The labor market, of course, is not helping either. Private sector data shows the jobs engine slowing hard. Firms have been shedding more than 14,250 jobs per week heading late October. That is not good, man. September alone saw a job drop of 32,000 private sector jobs, the biggest decline since early 2023. And announced job cuts in October surged 153,000, the worst October tally in more than 2 decades. That pushed the total cuts this year to almost 1.1 million, the highest year-to-date total since the pandemic. Not all is well in the economy, and the Fed has kept rates too high for too long. Remember, the Fed's dual mandate includes maximum employment, so these numbers put a lot of pressure on policy. The other part of their dual mandate is keeping inflation low, which they may have to sacrifice inflation in order to save the job market. But this is where the macro opinions start to diverge. Stephen Mirren, one of the most hawkish voices inside the Fed, isn't calling for full QE yet, but he is pushing for fast and aggressive rate cuts. He's argued publicly that the bond market stability supports deeper cuts, not just these token moves where they're doing quarter-point cuts every meeting. It needs real aggression here. In his view, demand can be fixed with rates first, but if the economy weakens faster than expected, balance sheet tools could come into play. Balance sheet tools, of course, meaning QE, and that they're going to start buying shit tons of bonds back off the market. Deutsche Bank sees the scenario coming sooner rather than later. Deutsche Bank! Analysts expect the Fed to finish up QT, of course, in a few weeks. At this point, days, gosh darn it, followed up by a massive liquidity U-turn that looks a lot like QE, but they're not probably going to call it QE. Again, it'll be technical adjustments of some variety or another. Now, they're not saying QE tomorrow, but they're saying the math points to a multi-trillion-dollar pivot once funding markets tighten up, and we're heading towards a situation where funding markets are getting a little too tight. This isn't just a U.S. story, by the way, but I think it's really important to point out. Japan, the world's fourth biggest economy, is also weighing a massive 17 trillion yen, about 110 billion US dollars. Stimulus package, if it goes through, that liquidity will stack right on top of the U.S. easing cycle. China's also printing as well. And all this creates a combined liquidity wave that could wash straight into global risk markets. So, is quantitative easing as we know it before coming? We don't know for sure when it's going to happen, but it always comes. It always comes. Probably it's going to come this time, or at least in the near future, in some form of technical adjustments, but don't make any mistake to understand that they will indeed inject liquidity into the system. Quantitative tightening will end before the year is out. That alone stops liquidity from being drained, which is a big deal. On top of that, Fed insiders like Mirren are advocating for deeper, faster rate cuts. He's not alone anymore, by the way, which could pour even more fuel into the market. With the job market showing signs of weakness, the Fed might not announce QE officially, but liquidity must flow. That's what markets respond to. And history shows that when liquidity flows back, risk assets tend to benefit the most. Sometimes you might need a little bit of turbulence first. I think we're experiencing a bit of that. The government shutdown definitely started seizing the system up a little bit. So be careful. There'll be shakeouts. Things can be rough sometimes. But in short, the stage is being set. QT ends, rate cuts accelerate, stealth QE starts coming underway. Markets may not surge overnight, but the environment is becoming increasingly supportive for risk assets. Financial conditions have not been this loose in a long time, and they're getting looser. The last 2 times this setup played out, it helped to lift markets out of recessions. So imagine what could happen if it unfolds during, well, the current stock market trend, right? But I think Main Street, to some extent, has been in a recessionary period. And that's going to be coming to an end soon as well as the Fed policies change. By the way, if you want to stay up to date on equities, crypto, prediction markets, all kinds of stuff, we have an insane newsletter. It's free. It's free. There's a link down below. Go check it out. Thanks for watching.